Sunny watched in horror as her life savings disappeared before her eyes.
A major fraud scheme has just been uncovered.
Financial fraud cases surge,
raising concerns about the broader
Who's really
economy.
behind the biggest financial
Fraud at an all-time
a major fraud case with millions
Digital
of
fraud
dollars.
cases are rising faster than ever before.
My name is Rob Bezdjian, and over the past 5 years, I've dedicated over 7,000 hours to proving to regulators, and now to you, that Wall Street has been designing complex structured products based on mathematical principles with the sole intent of defrauding investors. How will I prove this to you? It's simple. I'll show you how I profit by betting against these products. Welcome to modern day card counting. In this episode, we're going straight for the jugular. I'm going to show you how ProShares has stolen over $10 billion of your money through the creation of just one of these complex products. And they've created dozens. Best of all, I'll show you exactly how I profit from this in a model I like to call a day late, dollar richer. Let's go. Hi, I'm Rob Bezdjian. In the last video, I provided a summary of the last 5 years as an SEC whistleblower. I provided a reading of the cover letter my attorney and I sent to the SEC in December of 2024. If you have not had the opportunity to watch that first video, it's mandatory before watching this one. In that video, I provided a quick summary of how we can use publicly available information and calculate the daily issuance or redemptions of all ProShares leveraged exchange traded funds. In this video, I would like to demonstrate where you can find this information and verify what I previously provided to you. I will briefly walk you through how we get to that number, but before I do, it will be helpful to first explain two things. First, the vast majority of assets held by any leveraged ETF are nothing more than financial products called swaps. These are contracts between Wall Street firms. So what does that mean? It means that ProShares, along with their Wall Street counterparties, have created financial products that don't generate cash, and any performance in the direction that would benefit investors comes at the direct expense of ProShares and their Wall Street counterparts. It comes from nothing else. With that said, do you think Wall Street would ever create a product where they could lose? It's doubtful, but let me prove it to you directly. My claim is that ProShares and Wall Street banks are smart enough to create financial products where they know the outcome ahead of time, before the products are created and sold. Simply put, Wall Street created a class of structured financial products that are the equivalent of digital snake oil. For those who may be familiar with gambling, hopefully you're not, let me put this in other terms that you may understand. Casinos know ahead of time that when gamblers exchange cash for casino chips, on average, fewer casino chips will be redeemed for cash at the end of the night. These financial products, these structured products, are no different, except that the majority of investors who have exposure to these products have no idea. Someone else has made that decision for them. But if you would like to learn how to follow along and calculate the profitability of these products, even on a daily basis, let's do that now. As I mentioned, ProShares provides historical daily NAV and net asset information for all of their leveraged products. To view that and to do analysis, we're going to go to www.proshares.com. We're going to click on our ETFs, geared and leverage ETFs, broad market ETFs. And now I just want to show you one quick product, which was highlighted in the previous video, product SQQQ. So we're going to go ahead and click that link. We're going to go here to the NAV history. Also, we can look at the prospectus or fun fact sheet, but we're going to look at the NAV history. This will open up a CSV file for us. Let's go ahead and do that. Okay, we're going to go ahead and click on this link. Okay, when you pull the information from ProShares, you're given a spreadsheet with columns A through I. I made some simple calculations to determine the cash flow, how much cash was going into ProShares from investors versus how much investors were receiving with redemptions. First thing we need to do is calculate the actual number of shares. So take the shares that they provide us, times it by 1,000, because they're only giving us every 1,000th share here. Then we need to calculate the daily change in the share count day over day to determine whether that day had an issuance of shares, in which case cash was coming into ProShares, or a redemption, meaning that the share count went down.
from the 3rd to the 4th, we had a reduction of 6,150,000 shares. That means cash was being returned to investors. What we did was we took this number and times it by the prior day's NAV. That's an assumed value, but it's going to be close enough for our purposes. We don't know the exact price in which those shares were redeemed, but the prior day NAV, if we hold that consistent for the entire analysis, is going to be close enough. If we do that, when we take the net issuance minus the net redemptions, we have a difference of $15.4 billion. I want you to put that in perspective with a product that has assets under management currently at $2 billion. And if we scroll down the spreadsheet here, we see it as high as 5 billion, 6 billion, but we don't see it much higher than that, and we see it a lot smaller. This is an extraordinarily profitable product to have $2 billion of current liability. And why do I call it a liability? Because it's the shares outstanding times the current NAV. This can be demanded by investors, and ProShares is obliged to redeem the ETF at any time investors want. The outstanding liability is 2.1 billion currently. We see that here, and it's also the number of shares times the current NAV also gets you the 2.1 billion. That gives us a gross profitability, just looking at cash going in from investors minus cash going out from investors, of $13.3 billion. We can use this information on the spreadsheet to follow along a day late, and we can trade off that information if we so want to. So let's look at what the results were if we did it a day late. If we followed this with a day lag, our net issuance minus redemptions would be 13 billion as compared to the 15 billion because we're following a day late. Our outstanding liability would be the same, and we'd have a $10.9 billion profit. But we don't have as much money to trade as ProShares has, but we can scale it down into normal, mortal, human level. So a regular person, all I did, you can change it however you want to yourself, but I made a regular investor column here, which is 1/100,000th of the size of the ProShares. So when ProShares did a $15 million redemption, if we were trading along with this, we would be buying back $152 on this day. And back on the 19th, we would have sold short. This is cash coming in. If we're following along, when they issue shares, it would be us selling short 562. Divide it by the number of shares. Once again, I'm playing lawn darts here. I'm showing you how to follow along with a fraud. You can do with this information what you'd like. As a regular person, we would currently have $21,000 short of this product if we were matching what ProShares has at this exact moment. And we would have made, from inception over the past 15 years, $130,000, with $21,000 is a current liability, our current short position, and a gross return of $109,000. But once again, $21,000 short is still decaying, and we can assume that over time, we would also collect the majority of that. I hope you enjoyed.
So now that I've shown you where you can find historical information for all ProShares products, now what? Well, you can do what I did and run various analysis on the daily, quarterly, and yearly profitability of these products, especially when viewed through the eyes of Wall Street. And it's possible to bet against these products in proportion to their issuance, as I demonstrated with a day late and a dollar richer. If you do, over the long term, you are as guaranteed to make money as Wall Street is, and you can make it in direct proportion to the size of your portfolio. As I stated before, there are much better ways to count cards than pretending you're the dealer, especially if you're copying the dealer a day late, even if it makes you a dollar richer. So let's do this. Once it's consensus, meaning the public confirms the amount of profitability of these products and the amount lost for the benefit of Wall Street, I will show the world how this same daily information that you just saw can be used to bet against these products with even greater profitability at a lower risk than the market with greater returns. Some of you may have already seen it. If not, I will show the world in time and in public. Now, in my last video and in the cover letter sent to the SEC, we pounded the table on the man in the mirror model. I've proven mathematically and otherwise that it beats the market over the long term, just like card counting beats the casino at blackjack. You may not win every hand, but you win more often than you lose, and you win larger hands than those that the casino wins. It is no different with these products. It's a mathematical fact that can be validated, replicated, and repeated. Until the rules are changed, the man in the mirror model will continue to win. Why? Simply put, I enhanced the fraud that Wall Street created and turned the tables for the benefit of you, the investors. In the next video, I will showcase a dashboard we've created to backtest the man in the mirror model and to track it going forward. And I will also walk through the man in the mirror model via good old-fashioned spreadsheet for those that are old, just like me. Like I mentioned before, I was right 5 years ago, and I'm right now. You can follow my work with no risk to yourself. I'm doing this because it's the right thing to do, and no one else would. In my opinion, too many people accept fraud because there are no incentives to stand up and do what is right. Perhaps the world would be better if good people fought for the right things. I look forward to showing you the man in the mirror model next time, along with the dashboard. But if you want a cheat sheet and you don't want to wait, I'm not going to share with the public anything I haven't already provided to the SEC, and it's all in my book, Structured Fraud. In addition, we are currently building a tracker that will track the issuance and redemptions of not just ProShares products, but of all leveraged exchange-traded products, so that the public can see the aggregate issuance and redemption on a daily basis, along with any profitability that Wall Street is making at the expense of investors. It's my hope that as I and others start to shine a light on these products, that investors are protected. There is no reason why Wall Street can't play a fair game. In fact, some would say it might even be pathetic that they have to make money at your expense. I have just demonstrated, and hopefully you have validated, that ProShares and their Wall Street counterparts have made in gross over $16 billion in the product SQQQ. And if we subtract their current liability of the $2.3 billion in the net assets, meaning the share price times the number of shares outstanding, that they have made nearly $14 billion in that product. We must remember that SQQQ has a paired counterpart, a paired product, a leveraged long product. That ticker is TQQQ. And if we look at the net assets, meaning the current liability of that product, roughly $25 billion is currently outstanding. Let's remember, investors gave Wall Street cash, and Wall Street has given out chips that we'll call TQQQ. For the time being, in that one product, investor chips have actually grown. From 90% of these products, investors have lost money, and in aggregate, investors have lost a lot of money. But for the time being, product TQQQ has actually made investors paper profits. Well, remember, paper profits are bad for Wall Street. So, in the medium and long term, what do we think, which direction do we think TQQQ goes? Does it go up or does it go down? Remember, if it goes up, ProShares and their Wall Street counterparties, meaning Goldman Sachs, JP Morgan, Citigroup, Numera, and others, in fact, let me show you an entire list right now, lose money because they are on the hook for continued upward performance. But if that product goes down, and if it goes down big, like it did in 2022, that current liability shrinks. Remember, shares have already been sold to the public. That money has been brought in by ProShares and their counterparties. Now, they know, Wall Street knows, just like a casino knows, they want to keep investors playing so that when the chips are redeemed, they're redeemed for less than the average issuance. It's important to note that ProShares and Wall Street are very good at their game. They're very good at making money, just like the Quickie Mart next door, the 7-Eleven is very, very good in aggregate of making money. ProShares is providing products to the masses, just like a Quickie Mart provide Snickers bars and Monster Energy drinks and cigarettes and the like. For some products, the penny candies up front, a Quickie Mart or 7-Eleven may be willing to lose a little bit of money if you're buying that expensive energy drink at a 70% margin. If we look at this like a business, if we look at this in the eyes of the issuers in Wall Street, it becomes very obvious this was a fraud from the start. And all that's needed is a little bit of sunlight, which I hope I'm providing to you, to make this fraud go away. Because once again, it's not individual investors that are willing to bet on this, that are walking into a casino knowing. These products are being hidden in other ETFs, mutual funds, pension funds, and the like. Investors who do not know they have exposure at their detriment. In fact, there are two very, very famous managers, asset managers, one for a younger generation and an OG, that have given investors exposure to these triple leverage products at the detriment of investors. I'll show more next time. Thanks.